Thank you. Good morning and welcome. So my name is Sam Hossack. I'm the Managing Director of Prospect Resources. It's a great pleasure today to give you a brief update on where the project is and to introduce you to some of our most recent news flow and corporate updates. I would like you to take note of some of the disclaimer information. It's a requirement of the Securities Exchange. And there will be some forward-looking statements in some of the presentation material. As to who we are, Prospect Resources is an advanced development story where we have the 87% owned flagship project. So we're a focused business on one project, which is based in Zimbabwe, and we are fundamentally focused on bringing that into production. So over the last couple of days, and certainly to cap off a year's work, Prospect Resources went into a trading halt. This morning we were able to announce the update of the definitive feasibility study, which is the basis of this presentation. And in conjunction with that, a MOU has been announced with Uranium One Group, which is a subsidiary of Rosatom, one of the largest uranium producers globally, and a new energy company with a strategic focus on lithium and battery minerals. So it's really caps off a year's hard work. Our management team have managed to upgrade the ore reserve by 39%, and there's some proportionate increase in net present value. And the technical work and the due diligence work that we heard a little bit about in the first presentation, that's really been perhaps a blueprint of how we've spent our year preparing for the due diligence and progressing through due diligence. Consequently, the upgrade of the ore reserve has led to, for example, a 100% increase in EBITDA in the first 5 years. So some really strong DFS outcomes. I'll take you through those, and a very promising MOU that we've signed, and the opportunity to take the strength of the definitive feasibility through a funding program. As to who Prospect are and why they are, we're sort of unique in a sense on the account of our metallurgy. We are a lithium business. We have good exposure to the battery and EV sector, but we're also unique in the sense that we have a petalite product, which is perhaps less favorable in its lithium content in comparison to spodumene, but vastly superior in its value on the account of its rarity and uniqueness. So Prospect has the opportunity to deliver two products to the market, and that gives us a sense of uniqueness. And finally, we have a management team that not only have the technical capabilities to dream up a project, but have a long pedigree in delivering projects to market with a clear plan on ramp-up and a clear plan on revenue generation and debt serviceability. So we're unique, but we're focused, and we believe we have the right management team to take this project through its development cycle. We're based 38 kilometers outside Harare. There's about 12 to 14 kilometers of road that will need to be sealed. It's a strip road, but basically we're on the doorstep of what is the capital city of Zimbabwe. It's a large, hosts a large workforce, has good access to services, infrastructure, water, power. Interconnection is around 13 to 14 kilometers from the site. So this is a very favorable location for a project, in our opinion, in a jurisdiction where there's over 100 years of mining experience and really is a substantially mining-orientated export economy. Fundamental to our project has been government support. Zimbabwe is in a transition. It's in a strong recovery, and underpin that economic recovery, it's really pinning its hopes on economic revenues from mining businesses, the extractive sector, and Prospect has been, in a sense, has benefited from strong government support, keen interactions with our Home Ministry, and at this stage we're fully permitted and ready to go. So the basis of this presentation is to try and give you an illustration of our economics, take you through how the definitive feasibility stacks up, talk a little bit about the underlying asset, which is the mineral reserve, to talk about the growth opportunities in the EV sector, and particularly to provide some information on petalite and how it's consumed and why it's such a significant and rare mineral. And finally, I'm going to try and convince you that this is Africa's leading lithium business. At the moment, there's been a strong rush on the lithium, certainly on the hard rock lithium in Australia, but we're probably at this stage the 7th largest hard rock deposit globally, and we would like to see ourselves as being the most advanced frontrunners in Africa. So the key highlights, we have an annual EBITDA of $168 million. That's an average over the first 5 years. Over the last work that we did, which was around 12 months ago, that EBITDA has increased by around 100% on the account of mine planning, change in approaches to extraction, and that we see that as really underpinning strong serviceability of the debt finance that we're in the process of securing. The capex is $162 million. A year ago, it was $165. Our focus hasn't been on capex reduction. I guess we get some security from the fact that this number's remained largely static over the last year. So the conditions around capital estimation have indicated that they're stable, and this is a de-risking in a sense. We don't see our capital estimate moving substantially. So that should give investors and certainly our finance partners comfort. The net present value of the business discounted at 10% is $710 million US. Previously it was at $511 million. So there's been an increase in the reserve. We've managed to change the mine design from 4 pits to around 5 large pits, and brought more of the mineral reserve into the mine plan, increased the life of mine from 12 years to 16 years, so there's some substantial improvements there. Internal rate of return is 71%, previously 44%, and importantly for our finance discussions, the payback period's 18 months, which is around a 12-month reduction. So the global aspect here is really to understand the debt serviceability and project finance serviceability of this business as we take it through the development cycle. We've put a large focus on the ramp-up period. We heard a little bit about that earlier. Ramp-up hasn't, in a sense, been well performed in some of our Australian peers. We've learned a lot this year. We tend to feel that we've benefited from some of those hard yards that we've seen our peers undertake this year. So at this stage, we've got an 18-month period from financial close through to first operations, and approximately a 36-month period from financial close before we've achieved project payback. So it's really tight. There's some conservatism nested into our assumptions, which we believe meets the, shall we say, the prudence of bank corporate finance and finance serviceability. So we believe this is a strong narrative. So we've done an assessment on the sensitivities of our project to the key variables, and this is a very common technique undertaken to to assure the banks and our finance partners, our shareholders, that we've understood where the focus should be during the project. Certainly, a lithium concentrate base case, i.e. the long-term pricing that we've assumed, certainly indicates a sensitivity. We are at what we would probably expect to see as a low in the lithium pricing scenario. And importantly for us, we've looked at what our peers are using in their long-term forecasting, both operating mines as well as the peer group in development. And we are looking at a pricing that's below their average. So I think we've made an effort to take more conservative pricing to ensure that we really stand out in terms of our risk assessments. The second key point here is really operating cost base case. Operating costs for us are a function of the very low strip ratio that we have, leads to very low mining costs, the extractive techniques that we will use, the energy that we'll consume, the labor that we'll recruit, puts us very squarely in the lowest cost quartile. And again, we've run those OPEX numbers over a number of years, and they remain quite stable. So a bit of confidence around that, although we see that as a sensitivity. And lastly, lithium recovery. One of the key words and pivotal points for the last year for us has been variability, test the variability, understand variability, plan for variability. And in many cases, this DFS has seen a reduction in our global recoveries on the account of the conservatism that we would like to introduce to ensure that we're very successful in our initial ramp-ups. And just to reinforce the point that was made in the first presentation, sensitivity to capital cost is very low. Although we are in the lowest capital intensity quartile, we're not driving this project on the account of its low capital cost. One of the key management focuses has been ensuring that we have a very consistent supply of product to the market, that we are not prone to interruption from market dynamics, particularly low pricing scenarios. And so this graphic is an illustration of not only what our OPEX costs are per product, but importantly, what those margins would be throughout the long-term life of the project. So in today's current scenario, we would probably be sitting with around a 40 to 50% operating margin. And importantly for us, from the very beginning, has designed this plant to sustain and compete as a lowest cost quartile producer. And we fairly and squarely achieve that. Just to talk a little bit about our staged planning and our mining. It's an open pit design, so it's a very near surface deposit. I think the deepest point of our pit's around 140 meters. And that's really driven the mineral reserve upgrades that we've done this year. Even in a very high price scenario, we've not seen that pit drive any deeper. So I think we understand very carefully through our work with CSA Global exactly where the pit parameters are. And so at the moment we have under ore reserve 37.4 million tons, grading 1.22%, which, as I mentioned earlier, it's a 39% increase in our reserve, puts us around 7th or 8th largest hard rock deposit. So really a material position to hold. Flow sheet, very classic, dense media separation for petalite, flotation for spodumene, lots of variability. Testing has gone into some of these assumptions, and we feel we've understood exactly where our peers have struggled. In terms of the long-term outlook, and I'm going to have to pick up the pace here, but in terms of the outlook for lithium products, we come onto the market, or plan to come onto the market in 2022, which is around a year after an electric vehicle and an internal combustion engine vehicle reach parity in price. So we see that as a pitch point in the uptake of the EVs, And certainly for us, that's an important market entry position. And lastly, I'll probably just take a couple of seconds to explain that we are able to penetrate 100% of the lithium market. The lithium market's made up of 17% licensed ceramics, and that's really where the very ultra-low iron petalite, which is a premium product, it's very obscure, rare in its formation, and there's only one or two producers that we're aware of. So would be one of two global producers as we come into the market to produce this ultra-low iron petalite. And the value in use drives the actual cost of that unit to around 60 to 61% of the price of spodumene. So it's highly sought after. It's short in supply, and we see that as a market opportunity. And I think I'm going to have to call that a day, because that's the end of my time slot. And I'll leave you with the thought of our implementation plan. So thank you very much.